welcome everyone. We're going to be chatting today about crypto, venture capital. Going to be talking about the market and hanging out with these incredible investors. So if we could just go down the line, please intro yourself, give a quick blurb on your background, your firm, and your investment focus. Seth, we'll start with you.
Seth Gins, managing partner at CoinFund. My background is 18 years, large cap growth, public equities investing, got into crypto in 2012, joined CoinFund at the beginning of 20. At CoinFund, we are one of the largest crypto asset managers, just under $1 billion AUM, across early stage venture, mid stage venture, liquid, and we have index products now as well. The Consensus Ethereum staking rate was our first product there.
Hi, everyone. Excited to be here, especially as a Circle alum. I started my career at Credit Suisse. I covered fintech and payments on the equity research side, so have a research background. I then joined Circle to actually build out the OG Circle research function,
which we're relaunching today.
Yeah, very exciting. Congrats. And then I went to Fidelity Digital Assets, did sell-side style research on the crypto space there for clients of the custody and trade execution products for Bitcoin specifically. And now I'm a GP at Castle Island Ventures, which is an early stage venture capital firm that invests solely in the crypto space. Our sweet spot is picks and shovels infrastructure, so that includes, custody, trading, data and analytics, compliance, and a lot more. Very excited to be here.
Hey everyone, I'm Tom Schmidt. I'm a GP at Dragonfly. We're a global crypto venture fund, been around since 2018. Currently on our third fund, which is about 650 mil. Before Dragonfly, I used to run product at 0x. So if you've used Matcha or 0x API, worked on DEXs before. DeFi, we called it DeFi, and then before that I was a product manager at Instagram for 3 years.
Hey, I'm Joe McCann, founder, CEO, and CIO of Asymmetric. My background is about 23 years as a technologist and a trader. So I used to trade on Wall Street years ago, and then also was the founder and CEO of an open source enterprise infrastructure company called NodeSource. So I've been an operator and an entrepreneur and someone who raised money from venture capitalists. I raised $40 million for that business and sold it in 2019. I've been in crypto since 2016, angel investing since 2019, and launched my fund last year, Asymmetric. We actually are an early stage VC fund for crypto and Web3, and we also have a directional long-short hedge fund as well.
So guys, it's an incredibly weird market because it's an absolutely brutal bear, but at the same time, it's an incredible time to be investing. I want to take a quick step back and read some numbers. There's over $60 billion deployed from crypto VCs in the past 2 years across 3,000 deals. However, this year, we're down to just about $4 billion in total. So actually, crypto companies raised less money this entire year than they did in just Q2 of last year. Valuations are also down significantly, and by all accounts, I think crypto VC is dead, yet here we are. So how do you think the current environment affects the way that you deploy capital? And I'm also curious in how you all are advising your portfolio companies to kind of weather this storm. So Seth, we can start with you.
So we invest through cycles. We actually raised our fourth early stage fund this year. That was $158 million. So we believe, as happens in traditional markets as well, the bear markets are the best time to be deploying. There's certainly less deal flow today than there was last year, 2 years ago. But that means we can be patient. We're not rushed into deals, and we can be very deliberate about the areas that we're focused on. So we also have a lot of dry powder in our Series A fund, $325 million, that we raised last year. Same story. We've been very deliberate. The Series A part of venture has a little less deal flow right now. That's going to be, I think, a very interesting part of the market to have exposure to, both as you get repricings from the prior bull market as well as the next crop of early stage projects graduating to Series A. So we're very bullish on crypto long term, very excited to deploy our funds, but we're taking our time, being deliberate, and maintaining a high quality bar.
I think one key point is that even though there are fewer deals in the market right now, I think in a bear market, the people that are left are people that have high conviction in the space. So I think the quality of founders is definitely significantly higher. And you just know, in having those conversations, they're a lot more patient, looking for the right partner. And, they're just in it for the right reasons if you're building in a bear market. So I think that's one huge positive of deploying in a bear market beyond just, obviously getting better valuations. Yeah. I think, I lost my train of thought, but maybe it'll come back to me.
We'll come back to you.
Happy birthday, Ria, by the
Oh,
way.
yeah, happy birthday.
Had to drop that one,
Thank you.
We're doing a birthday happy hour after this. Yeah.
I agree with a lot of what's said. I think we've had a lot of portcos who chose the wrong partner in 2021 come back to us and be like, oh, Fund XYZ isn't returning our emails. I was like, I fucking told you that would happen. And I think in some ways, the market is actually worse than the numbers make it out to be, because you see, these deals get announced in the news. Those happened a year ago.
Yeah, 2 years ago.
And so in reality, it is kind of dry out there. But I agree that has just sort of distilled down, I think, the signal. And so you see a lot more interesting founders, more dedicated founders. I think the rounds are in some ways easier to put together because you can get to know each other. Generalist VCs have basically evaporated. A lot of them won't even talk about crypto or be associated with crypto. So I like that component to it. But I think the tricky part is doing sort of later stage right now. I think seed is great. Valuations have come down a lot. There's still space for VCs that want to allocate. The problem is when you get into A and B teams that really, I think, kind of screwed up their evaluation or cap table, were not really diligent around burn. They're in a really painful spot where maybe the business is working, but just not where it needs to be to hit the valuation that they want. And so when we talk to these teams, oftentimes we think about how can we add some structure to have this make sense without having to be too painful for the team or previous investors and things like that. So, overall, I would say the market is not. It's still better than 2019. Honestly, 2019 was miserable. But it's maybe a healthy correction is more the point.
Yeah, and to not just repeat what everyone just said, because I agree with everything they just said, I'll talk a little bit about the second half of your question, is kind of how do we talk to founders and advise them on the current state of things. So a couple of things. One, and this gets to Tom's point, is we really encourage founders to not optimize for dilution and a high value valuation now, even though the market tends to not pay for it. Because to his point, you need to build a company that's going to grow into that valuation. The second thing is you have to be extremely judicious with your burn. And if you're a CEO, you're not here to win a popularity contest. You have to run your business, and you have to make really tough decisions. And so it sucks sometimes, but that's the job that you picked. And so you have to acknowledge that and take full ownership of that. I think the other thing is that what we have found with some founders is they're starting to actually acknowledge that a pre-seed or seed round that's a $6 million or $8 million valuation actually makes a lot more sense to them. That's better for investors as well versus these kind of incredibly inflated valuations that we saw, 2021, parts of 2022. At Asymmetric, we've been relatively steady state with how we conduct due diligence on all of our deals. So we, if a founder contacts us and says, deal's closing in 5 days, we're like, great. We won't participate. We just have to maintain.
Seemed like it was such a trend 2 years ago.
Yeah, exactly. We maintain that steady state, whether it's a bull market, it's a bear market, it's FOMO, it's despair, it doesn't matter to us. And so that's helped us kind of stay level-headed, but I think it's most important for us to have a prepared mind because we don't want to say, oh, it's a bear market, we're not going to deploy. That's just foolish, in my opinion, by having a prepared mind around the theses that you have around crypto and identifying those killer founders that are going to actually build that stuff, irrespective of the market conditions. That's when you write the check.
I remember the last point I wanted to make, and I agree with what everyone's mentioned on this panel. The number that you mentioned, the amount of total venture capital funding into the space has been significantly lower this year. Obviously, fewer deals, VCs being a lot slower and deliberate in how they're deploying capital. And then I think the third thing is also that founders are also being more thoughtful around how much capital they should be raising based on what stage they're at. So, I think in the bull market, founders, obviously there was a lot more access to capital, deals were oversubscribed, and they just expanded rounds significantly, which can be detrimental in a lot of cases. And, I think part of it is also that they're just being a lot more thoughtful around how much capital should we actually raise right now. That makes sense for the stage that we're at.
I do want to say one more thing, because that reminded me of something that's happened recently over the past, call it 8 or 9 months. Back in my day when I was raising money from venture capitalists, this would have never happened. I had a number of teams, to your point, that raised copious amounts of money in 2021, have just thrown in the towel and returned capital. And look, sometimes that makes a lot of sense, but if you're a pre-seed or seed company and you're throwing in the towel 9 months or 12 months in because it got hard, you're probably never going to be able to raise money again, because your track record now points to prospective investors in the future that you threw in the towel in about a year. And so I have actually seen a handful of these, a couple of my own investments that I've made have gone down this path. Again, it's not a judgment against the founder, but it is odd. But I think it's also reflective of what was happening in the previous 2 years prior to this bear market.
It was almost like crypto became really hot, money was easy, you're a talented founder, maybe from a top tech startup, you raise, and then bear market and you're out.
That's right.
We do see teams also pivot out of crypto, which in some scenarios has actually worked pretty well. Like, I've been impressed. Great founders can go on to just take this sort of core idea and go do something else with it.
Is that a customer, like not being able to identify customers? What was the main?
Yeah, I mean, they maybe build their product, or they're getting poor customer feedback, no traction. They're like, okay, we'll pivot or do something else, or maybe the crypto component was kind of weak in the first place, especially for pre-seed or seed. It's a lot more about the team. But I think that the flip side is we also see teams that have raised a lot of money, and then it basically turns into like a search fund, and it's like, well, that's not really what we backed here, So there's I think like a degree to it,
How much of that do you think is based on the current regulatory environment here? I mean, we could list off the accolades of crazy things that have happened over the past year. We've talked about this a little bit. Like, there is a very U.S.-centric view. Crypto is very global. But still, if you look at the deal data, like, most of us are still deploying into the United States. There's a large developer population here, but the users are predominantly concentrated in Asia. About like 60% of crypto users are in Asia. So, like, how do you guys navigate that, and how does that also affect your investment thesis?
Yeah, I can give some perspective. So Dragonfly, we may have a unique perspective on this too. I'm in New York. We have about half the investment team out here. And then we also have an office in Singapore. We've got half the team out there as well. And so really, our portfolio, our LP base, our investment, our portfolio is kind of split 50-50, Asia-US. And so we see a little bit of what's going on in both locales. And I think, I think you're right. I mean, I don't know if I would be like a consumer crypto founder or DeFi founder in the US in 2023. It's really hard out there. I mean, you see these settlements coming out that are like bullshit. I don't think the CFTC is really like acting in good faith, or the SEC for that matter. Let alone potentially facing some bullshit criminal charge for something that is very reasonable in other locales. And like, everyone loves Friendtech, right? Friendtech is this hype. That's not like a technological breakthrough, right? Like, you could have easily built it on any sort of mildly high performance blockchain. The difference is no one was willing to take the risk, right? You could easily say, this is an unregistered securities platform. This is an unregistered exchange. Where's your ATS license? Blah 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 blah. But like, it needs somebody who's actually going to be willing to take the risk, and it's 10 times easier to take that risk when you're outside the U.S. And so that's kind of what we see is teams. I think overall, if you're looking for technical prowess, I don't think the quality of those teams is as high in Asia as it is in the U.S., but they just have a lot more free reign to run with when it comes to actually building the product that is solving a problem that people face. And
they're building in jurisdictions where there's clear rules.
Totally.
Yeah.
There's an interesting, I was over in Singapore 2 weeks ago, and there's an interesting dynamic where, coming out of ECC, a big developer conference in Paris in July, the big concern was you have a lot of development around infrastructure, a lot of new infrastructure companies coming out, but not a lot focused on the app layer. And the question was like, what good is all this infrastructure if we're not seeing innovation on the app layer? Go to Singapore, and of course, Hong Kong is opening up. And Hong Kong, as a special administrative region, is a place where people can go from the mainland. And we heard over and over that developers coming out of Tencent, Alibaba, NetEase, ByteDance, the big Chinese companies, don't feel comfortable working on Web3 onshore in mainland China, but they do in Hong Kong. So you're seeing, it's interesting, you're getting this, and those are app developers, right? So there's like the early seeds of a really interesting development of applications, and these are some of the most viral, some of the largest user bases have been developed in Asia, being built out in, or in the early innings of being built out in Hong Kong and Singapore. And then we have the infrastructure activity that's happening in North America and Europe.
Yeah, it's interesting. There's like almost an overemphasis from VCs on infrastructure, but it seems like to be the complete opposite in other jurisdictions.
I would actually argue the opposite.
Okay.
I went to and judged the ETH Global Hackathon in New York last week, and going into it, I actually had this exact same thesis where I was like, all this infrastructure is being built out, but who is actually using it? So, there were primitives like embedded wallets. There were primitives like XMTP, which is wallet-to-wallet messaging. There's a massive influx of transaction activity on L2s. And a lot of the applications, everyone that pitched me was building an application, not infrastructure, using all of these primitives that didn't exist 1-2 years ago. So I actually think that, that might be like a leading indicator of some of the more innovation we might see around applications, which speaks to this, thesis that USV published a long time ago about application begets infrastructure, begets more application, and so on.
Yeah, you want to say something?
No, go ahead.
Good. So I was just going to say that I think I'm of the belief that the value is going to be at the application tier. Just always thought that. It doesn't mean that there isn't value in infrastructure, but infrastructure needs to be created, and then you can create the apps, right? My view really is that, and I think we actually saw this with Friendtech, that mobile is actually going to be the major unlock for the applications. So if you just go back, 12, 13 years, when the iPhone and Android kind of duopoly really kicked off, mobile-first app development became a thing with software developers because they could build fundamentally different types of applications that you simply cannot build on a desktop computer or a laptop. The phone itself is mobile, obviously, but it has things like a GPS and a camera and all these other things that you kind of don't have or would want to have necessarily on a desktop computer. And we haven't seen that kind of unlock moment yet, really, in crypto. And no disrespect to the Friendtech dev team, but it's a progressive web app that is arguably in need of some UX polish, but it's exploded in activity, and it's not even that great of an experience. So imagine what would happen if and when, in whether it's Singapore, it's the United States, it's wherever, someone launches a really high-quality consumer-grade application that is kind of Web3 native. And I think this is consistent with what Circle was announcing today, where most of the Web3-ish stuff is just abstracted away from the user. It almost doesn't matter. So I think we'll start to see that more. Of course, this is somewhat restricted by Apple and Google and what they choose to do with, whether they're going to unlock the APIs for the secure enclave to sign transactions or not. But that kind of doesn't matter. Like, you're even seeing it with Friendtech. People are actually trying to build stuff that are somewhat more native Web3 on mobile. And I think that's where you're going to see like the large consumer applications break out. One
interesting, development or a few examples that I've seen, and maybe it's too early to call it a trend, but Joe, going back to what you were saying about like applications will capture a lot of value, I agree with that, but I also think it's interesting to think about some of the applications that are rolling out features that make them more like protocols, and they're taking advantage of this fact that like crypto is so composable. So one example of this is Uniswap started off as an application, and then it rolled out hooks, which makes it more like a protocol on top, on which other applications and developers can build. Another example of this is Zora, which started off as an NFT marketplace and is now rolling out Zora Protocol. Another one is this company called Joke Race, which started off as a governance platform for people to create contests. And, because all of that data is on-chain and interoperable, it kind of becomes like an on-chain protocol for data. and reputation and so on. So I think that's an interesting development that I've been noticing recently.
It's a great segue into what's been branded the killer app of crypto today, which is stablecoins. I'm going to quote some stats here from Peter Johnson from Brevin Howard's recent stablecoin report. But in 2022, over $11 trillion was settled on chain. That's about 70 to 80% of all on-chain settlement activity. Completely dwarfed PayPal volumes of 1.4 trillion, almost surpassed Visa at 11.6 trillion, and reached about 14% of the global volume settled by ACH. There's over 20 million addresses that hold between $1 to $100 worth of stablecoins, which would make it the fifth largest bank in terms of bank account numbers. And so stablecoins are absolutely exploding, also in a time when the market is in quite possibly one of the worst positions it's ever been in. So I'm curious, and Joe, we can start with you. Like, what excites you about the future of stablecoins? What applications are you seeing today? Yeah, I would love to hear your thoughts.
Sure. Yeah. I mean, I've been beating this drum for a long time. I actually really do think that, I don't know, sending money to someone instantaneously is a pretty powerful application. I was on a podcast last week, and they asked me if you had to show somebody that's not into crypto, the crypto app, or how would you get them to, what would you show them? And I was like, show them the Zelle app on a banking app, and then ask them to send money on a Saturday or a Sunday, and they can't do it.
Or send it globally.
Huh?
Or
send it globally. I mean, yeah. I mean,
experience.
just any of this, right? And so I that it seems trivial in terms of like, wow, it's not like an Instagram or something, right? But it doesn't need to be. It just needs to be. It just needs to work. And I think I actually kind of view. We talked about this in the past. I kind of view stablecoins almost like a protocol in and of itself, where if people can start to feel comfortable with this trusted settlement layer for digital dollars, well, then what are the applications that can be built on top of it? And obviously, we saw some of this in the keynote today. I think that's extremely powerful. And with a lot of the APIs and SDKs that are now available through Circle, I think you'll start to see a lot of those applications come to light very soon.
Yeah, I think, I don't know if it was just Nick or it was all Castle Island, just put out a really good talk on stablecoins and had a lot of great data in it. So recommend everyone check it out. I think it was at Token 2049. But I feel like stablecoins was kind of these things where there's always these like pieces of FUD, like, oh, like they're just printing tethers. And then, oh, they just people are just coming to like yield farm. And then like slowly they've all kind of gotten like semi-debunked or debunked in some way. And now it's like, okay, well, there's no actual yield farming to do on chain. So like people actually just want to use this, and the data supports it, that people are using for payments, for remittances, for savings, for getting access to dollars where they don't have access to dollars. And so I think that I agree it is kind of the killer app. I think the question, and I mean, there's like a bunch of companies right now working on the space is like, where is the yield, right? I mean, obviously we've seen these are incredible businesses because effectively it's like a bank that pays you, 0% interest and requires you to go get your interest somewhere else. And so now there's a bunch of companies, looking at things like rebasing stablecoins or ways to offer, treasury yield or close to it on-chain natively, which I think is like, even more compelling than I think some of the current stablecoin models that we've seen. I think the question is how that actually shakes out in a way that is ergonomically similar to how people want stablecoins today, which is, I can pay you, you can pay me. There isn't sort of some enormous KYC overhead in order to do so. And I think someone sort of threading that sweet spot, I think, is going to make a splash in the market. But all those companies are kind of emerging right now.
Yeah, I thought, just a quick note, I thought Nick's presentation was fantastic. Rhea and I were talking about it earlier. I agree with it, but just the sole euro dollar analogy is a little bit limiting because of Tether's dominance in the market today. And so that's why you have 75% of all USD stablecoins are issued outside of the US. And I think a lot of this is just gated by the regulatory climate, right? And so as we see that evolve, you should see people fully comprehending the fact that you can now move money at internet speed globally. And that should unlock a bunch of new stuff. Rhea?
Yeah, I think both of you brought up points that, we actually invested at this company called Mountain Protocol, and they're based outside of the US. They're licensed in Bermuda, and they're offering a permissionless yield-bearing stablecoin, but unfortunately to anyone that's non-US, right? So hopefully the regulatory environment here evolves so that that kind of permissionless innovation can enter this market and create value for everyone here. But yeah, it's exciting to see developments on that front. your original question was what excites you about stablecoins. So when I was at Credit Suisse, I saw, and I studied the payments ecosystem and fintech space, I saw firsthand how convoluted everything was and how many intermediaries there are in between a merchant and a bank that issues a credit card when you swipe your payment at the point of sale. And I think it's really exciting to see developments like what Visa announced with Solana that significantly reduces the risk and the speed and the efficiency of settlement across these intermediaries, and hopefully reduces the cost to merchants and to end users eventually of transacting via stablecoins.
I mean, the only thing that I'll add is, what excites me is product market fit and secular growth. And we did a presentation at the beginning of this year where we were like, okay, 22 was a difficult year, but let's look at where a whole bunch of metrics from the industry were at the beginning of 20 versus the end of 22, and stablecoins outstanding and stablecoin activity both were like two of the most compelling secular growth charts in that deck. So stablecoins outstanding, beginning of 2020, it was like 2 billion, right? And we're up 120, 130 billion today, in arguably the depths of the bear market, or
And
just
down
coming
from
out of
all-time
the
highs.
market. What's that?
And down from all-time highs.
And down from all-time highs. So just like product market fit, when people ask, what product market fit do you see in crypto? Bitcoin, digital gold, stable coins, top two on the list. And then obviously everything else that we're super excited about, but those are the two like validated product market fits right now.
Down from all-time highs, but not down as much as the rest of crypto, right? And I think it speaks to this fact that they are just so sticky and are, not tied to crypto bull and bear cycles. Like they're creating real value for people all around the world. And I think we often, being in the US, just take a very US-centric approach and forget that crypto just has the potential to unlock so much more for people in other parts of the world.
It was interesting you brought up Credit Suisse and Mountain Protocol. Stablecoins also bring new operational efficiencies, and we're seeing that with the explosion of real-world assets, which is kind of like DeFi 3.0, if you will. And there's various aspects of this. There's kind of regulated and non-regulated. So I'm curious, like, are you all investing in the real-world asset space? Kind of what particular parts of it are you most excited about? And again, like, how do we think about the regulatory piece of this? Especially if you're investing kind of on a 5 to 10 year horizon, like most venture funds do. Joe, we can start with you.
Yeah, I mean, we certainly look at a lot of these deals. We currently haven't pulled the trigger on any, and it has partly to do with the regulatory uncertainty. But I think from our perspective, there's also a lot of the kind of financial product incumbents are almost likely going to tokenize a lot of their offerings. And so that presents a major challenge to startups. And yes, you can't just use that as an investment thesis because somebody could just simply say, well, Amazon will just build this, so don't fund this tech company, right? That's not how we think about it, but it is a major challenge with the regulatory overhead. So we haven't seen a lot of anything compelling enough to pull the trigger on given those two reasons. However, the space is super fascinating to us. I think Citigroup put out a report, something along the lines of $4 to $5.5 trillion of tokenized assets by 2030. Yes, it's a forecast, but that's a real number. And we already have a really solid use case of a tokenized real-world asset, which is USDC. So there's prior art here and precedence for how to do real-world assets. We just haven't been able to kind of get across the goal line, so to speak, with a lot of the projects, given the kind of regulatory overhead as well as the incumbency of some of the financial product companies out there today.
Yeah, Joe said what I was going to say, which is we already have stable coins, which are the true RWA. I think we are doing some investments. Obviously, we're investors in Maker and Monotalis, which is what the platform that they're using to do a lot of their on-chain financing now. We're also investors in a company Stable, which is similar to Mountain Protocol, basically offering yield-bearing stable coins to non-US individuals. I think the question is always like, why is this on-chain? Right, like people have been trying to do security token issuance forever, and it just never has PMF because it's it's a bunch of it's 5 people who are KYC'd, looking at each other, paying exorbitant fees to like transfer this like house around on chain. It's like this makes no sense. I think it really only makes sense when you're offering a product you're expanding the market for a product, which I think you are with stablecoins, right? Offering USD to people who wouldn't previously have access to USD, or I think finding some way to lower the cost of capital and sort of making markets more efficient, making markets more liquid. I don't know if we're there yet in RWAs, but I think those are maybe 2 of the heuristics that I use when we look at new investment opportunities.
I think beyond stablecoins, what's interesting, and it's still pretty early, and you definitely don't have the kind of product market fit for this category that you do for stablecoins, but like loans on chain, credit on chain, bringing transparency, automation, and accountability to that part of the market, I think is very interesting. So we're investors in Maple, and we're excited about what they're doing in that category. Beyond that, haven't really invested as much in the RWA space, and yeah, agree with regards to, what is the reason for tokenizing these instruments? Is it bringing, diverse risk-adjusted returns that people don't have access to in traditional markets? I think there's a lot of open questions, but it's exciting to see the experimentation for sure.
There's this like beautiful irony with like RWA taking off right now, which is higher yields killed liquid crypto prices, but at the same time, higher yields drove attempts to come up with yield-bearing stablecoins. And that kind of opened a lot of regulatory experimentation. We're investors in Superstate, one of those companies, and you're seeing that then lead to people connecting the dots to the next set of assets. So that's kind of like one interesting dynamic with the increase in RWA activity that we're seeing this year. I think the other interesting convergence that's happening is we're getting more and more data off the physical world. And when you think about it, I remember having discussions 4 or 5 years ago, and by the way, to be clear, we've had many head fakes with RWAs over the last 5, 6 years, many of them real estate equity tranches, stuff like that. But I remember having a conversation 4 or 5 years ago about like, you're not gonna have tokenized real estate equity because you're gonna have no liquidity. Right? Like you're going to have all of these like disparate buildings, no liquidity. Right? If you look at the options market, you have resting bid-asks for all different strikes, all different expiries, and that's because people just use Black-Scholes and then like add in their own assumptions. What's going to happen, I think, and we're seeing us move toward this convergence, you're getting so much data out of the physical world right now, whether it's foot traffic, you can have drones, cameras, doing various machine learning analyses, you can get credit card data. You'll have market makers that have their own proprietary algos off of that data that allow them to sit there with like bid-asks that you could drive a truck through, but they'll sit there with resting bid-asks and provide liquidity into these markets. So there's some really interesting elements of convergence that are starting to come together and make this a viable market in the near term.
I want to close out by just getting everybody's thoughts on the future. What building blocks, what new technologies or other applications we haven't discussed here are you most excited about investing in over the next 5 to 10 years? Or maybe it's already here today. Joe? Can't say stable coins.
Damn. Okay, I'll be that guy.
No AI. No,
Come on, stablecoins and AI?
That's
What's
it.
better than that? No. I kind of alluded to this earlier. I do think mobile is going to be massive, probably in the intermediate term. This is going to sound super cliche, but there is something to be said about artificial intelligence as applied to cryptocurrency and programmable money. There's I think my friend Balaji Srinivasan wrote this paper many years ago about machines paying other machines. And you could do this without AI and machine learning, but now that large language models and neural networks are as powerful as they are and they're available via API, coupled with smart contract programming and programmable money, I think that there's something there that is going to be pretty revolutionary, where you're going to end up having these sort of, I don't know if they're autonomous agents or something along these lines, but the programmable nature of money coupled with I don't want to say sentient, but I would say more intelligent machines than what we've had today, I think is a very, very powerful combination. You'll see some very interesting stuff over the coming years.
Yeah, I think Joel Monegro and Chris Bernisky were just on Laura Shin's podcast talking about this and predicting that web traffic will 100x largely because of these agents. And therefore, if you apply crypto or stablecoins to that, you could see that that actually might be the biggest application.
I would agree with that.
Yeah.
Maybe a very different tack. I really want to do an investment in the sort of gambling space, and there's a number of companies now that have sort of taken off, and I think a good heuristic for like product market fit is willingness to pay, and stuff like Rollbit or Shuffle. They're making like insane amounts of money, and so it feels almost like kind of a return to like crypto's origins in some way. I think a lot of people got into the space through like online poker, and it feels like that just totally went out the window for a while. And so I think as you sort of seen with Frontech, like people like to speculate, and I think that's okay as long as it's done in sort of a way where the rules are clear and it's transparent. And I think these kinds of casinos can provide just a much better experience for that and a much bigger market for that than casinos in a lot of different other locales. And so I'm really curious about that space.
One thing that's exciting to me is that the options for custody are not black and white anymore, and user onboarding through things like MPC-enabled embedded wallets, smart contract wallets, and account abstraction. I think in the past, like 2 or 3 years ago, either it was you write down your seed phrase and you have sole responsibility over all of your crypto assets, all of your crypto data, or you store all your information and assets with a centralized platform. And I think we're seeing a spectrum emerge with things like account abstraction and MPC being integrated within wallet infrastructure that allow users to either upgrade over time as they get more comfortable with crypto, or decide where on the spectrum they are and like stick to that. So that's exciting to me.
I'm really excited about regulatory clarity. Because, and what I mean by that, what I mean by that, and by the way, like our house view is everything that's happening right now, if you step back, it's immensely positive. Because it's moving us down the path of regulatory clarity, rather than just having the SEC opine on what's a security, what's not a security. We're now going to have the courts give us a lot of clarity, hopefully Congress helping out on that as well. So we're on the path toward regulatory clarity. And that should be a secular de-risking of the space. Just think of it as like the discount rate coming down over time, and markets should start to price that in before we get to the end point. But just one example of why that's so important, think about like governance tokens, and think about how so many governance tokens have absolutely no value accrual today. And that's all a regulatory workaround. But the moment that you get regulatory clarity and we understand how to deal with digital asset securities, and I don't think any of us are going to be afraid to deal with digital asset securities once there's a clear regulatory framework around that, you can have tokens that represent equity in all different types of entities, in startups, in components of much larger companies. You can use it to micro-incentivize or make bets on a regional division within Walmart. There are all of these ways to divide what right now is a pretty analog investing universe, and that's where like AI comes in and all of the data that will be coming off of the physical world to price everything much more efficiently. And I don't think like a lot of it is going to be individuals doing these trades. A lot of it will be algos doing the trades. But I think it just opens up this like massive slate of investable opportunities and massively increases the efficiency of capital allocation. But we need that regulatory clarity.
Awesome. Well, that is all we have time for today. Please, let's give a big round of applause for our panelists. Thank you, everyone, for coming. And we're going to be doing a little happy hour out there after this. Thank you very much.